Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Rezolve AI.
If you find our talks useful, please consider subscribe, like, and comment underneath because today we have a really fascinating company to look at. We're breaking down a business that managed to grow its revenue by a staggering 2,200% last year.
Yeah, which is just a massive number.
Right. But the thing is, depending on how you look at the data, it might still be a massive speculative trap.
Exactly. I mean, it is basically the ultimate tightrope walk in the modern business world right now. We're watching a company try to cross that really dangerous chasm from, burning cash to build a science project to actually scaling enterprise revenue.
Proving the platform works in the real world.
Yes, exactly. And the metrics we're looking at today are, well, they're not subtle at all.
No, they really aren't. We've been looking at their full year 2025 earnings, all the recent insider trading disclosures, and a bunch of Wall Street analyst notes. Our mission today is to figure out if this transition is real.
Right, because those revenue figures honestly look like a typo at first glance.
They really do. So we want to help you figure out if this is a true generational hypergrowth opportunity or just another speculative bubble that's going to pop over the next 12 months.
And to really grasp the stakes here for your portfolio, you have to look at the sheer velocity of their growth. Because, I mean, a 200% growth rate doesn't happen organically just by, selling a few more software licenses.
Yeah, let's just put the raw numbers right on the table. In 2024, Rezolve AI brought in about $2.01 million.
Which is basically nothing in the tech world.
Right. It's proof of concept money. It keeps the lights on, pays the engineers while you finish the code. But then for full year 2025, that number skyrocketed to $46.8 million.
It's wild. And if you dig into the timeline, it tells this really fascinating story about their sales cycle. The growth wasn't just a steady month-over-month ramp-up.
It was super backloaded, right?
Yeah, heavily weighted toward the second half of the year. If you isolate just the back half of 2025, the growth hit 543%.
Which indicates a major tipping point to me. I mean, enterprise software sales cycles are notoriously grueling. It can take 12 to 18 months of pitches and security audits.
Pilot programs, yeah.
Exactly, just to get a massive retailer to finally say yes. So that back half explosion suggests that those long-term enterprise trials finally concluded. The ink dried on the contracts, and the revenue pipelines suddenly all went live at once.
And that's the absolute hallmark of scaling an enterprise platform. It is a slow, agonizing process to build the trust, but once the client flips the switch, the revenue just cascades in.
And management is projecting that this cascade is really just getting started.
Oh, absolutely. Their official guidance for fiscal year 2026 is $360 million in revenue.
Which is just, that implies another 700% growth on top of the monumental year they literally just had.
Right. And they're targeting an exit annual recurring revenue, or ARR, of $500 million.
I have to pause here, though, because it is incredibly easy for a management team to just throw massive numbers onto a slide deck.
That happens all the time.
Right. But to actually convince Wall Street that you can hit those targets, you need a product that the market feels it absolutely must have right now. So what exactly are they selling that's pulling this kind of demand?
So the core driver is their proprietary platform, which they call Agentic Commerce.
Okay, I have to say, I hear proprietary AI, and my initial reaction is deep skepticism.
Of course. I think everyone listening is probably fatigued by every single software company slapping AI onto their presentations.
Yeah, because a generic language model that just writes polite customer service emails is not going to secure a $360 million revenue pipeline.
Definitely not. And that's why we need to draw a hard line between what Rezolve AI has built and those generic chatbots. The difference really comes down to function versus execution.
Okay, break that down for me.
So a standard AI chatbot is essentially just a very polite store greeter. It can welcome a customer, answer basic questions about store hours, maybe point someone to the shoe department.
But it has no actual power.
Exactly. It can't ring you up, it can't check the back room for a different size, and it certainly can't order more inventory. It's just a conversation engine.
Not an action engine.
Right. But Agentic AI, with the agentic part, meaning it acts as an autonomous agent, is basically the store manager. It has the keys to the cash register, the supply chain database, and the marketing budget.
Wow.
Yeah, it's built specifically for the retail and e-commerce sectors, and it plugs directly into a company's global infrastructure.
Okay, so give me a concrete example of what that actually looks like in the real world.
Sure. So imagine a massive UK retailer has a specific jacket go viral on social media overnight.
Happens all the time on TikTok or whatever.
Right. A generic chatbot would just tell the next 1,000 customers, sorry, we're sold out. But the Agentic Commerce platform sees the viral spike, predicts the inventory wipeout, and autonomously takes action.
Like it actually orders more.
Exactly. It places an emergency purchase order with a supplier. It updates the shipping delay timeline on the website. It even temporarily pauses the Google ads for that specific jacket so the company saves marketing spend while it's out of stock.
That is a massive leap in utility. That's not a chatbot, that's autonomous digital infrastructure.
Yeah, exactly.
And their strategy makes total sense now. They're hyper-focused on high-value enterprise contracts in the UK and US markets. They aren't trying to sell a $50 a month subscription to some small boutique.
No, they're going after the whales who actually need that level of complex automation.
But let me push back on the business model for a second. The enterprise software space is brutal. If a massive retailer plugs this agentic commerce platform into their operations, what's actually stopping them from just ripping it out next year when, a mega cap tech company inevitably offers a cheaper bundled version?
Yeah, that's the multi-million-dollar question right there. And it all comes down to switching costs. In this case, those costs are tied directly to the network effect of the data.
Because it's learning from their specific systems.
Exactly. When an enterprise integrates Rezolve AI, the system immediately begins ingesting their specific localized data. Millions of microinteractions, seasonal purchase quirks, localized supply chain bottlenecks.
So it trains itself exclusively on that specific retailer's ecosystem.
Right. And the longer it runs, the deeper its utility becomes for that specific partner. It becomes hyper-optimized. So if a competitor comes along next year offering a generic platform for 20% less, the retailer can't just easily swap the code.
Right, because if they rip it out, they're effectively giving their entire autonomous sales intelligence a lobotomy.
That's a great way to put it. They would have to start training the new, cheaper AI entirely from scratch, and they'd suffer massive operational inefficiencies in the meantime.
Yeah, that dynamic makes the technology incredibly sticky. So the high switching costs give them real pricing power and high customer retention. That is a solid competitive moat.
Yep.
But let's look at the actual cost of running this business. Because look, hypergrowth usually comes with hyperspending. You can always buy revenue if you're willing to set enough investor cash on fire.
Very true.
We need to know if they are actually marching toward profitability or if this is just a cash incinerator.
Well, the financial health metrics are actually showing profound structural improvements. Back in 2024, their net loss was a staggering $173.45 million.
Ouch. That is the kind of cash burn that terrifies investors.
Yeah, it really is. But for full year 2025, even while scaling up to deliver that massive revenue growth, their net loss significantly narrowed to $101.41 million.
That's the metric that jumps off the page to me. They grew revenue exponentially while actively shrinking their losses. On a per-share basis, the diluted loss dropped from $1.06 to 38 cents.
Yeah, which is a textbook demonstration of operational leverage.
And that's really the holy grail for a scaling tech company, right?
Exactly. Operational leverage means you've already paid for the expensive foundational infrastructure. So now, every new dollar of revenue costs you significantly less to acquire and support than the previous dollar. Your margins just begin to rapidly expand as you scale.
We also have to look at the visibility of that revenue. They exited 2025 with $232 million in annual recurring revenue, and their December monthly recurring revenue, the MRR, was sitting at $19.4 million.
Right, so they aren't relying on unpredictable one-off software licensing fees. This is contract-backed, predictable cash flow.
Which gives the management team the confidence to forecast that $360 million target. But if you want the ultimate litmus test for how management truly views the company's trajectory, you have to look at the insider buying activity.
Oh, I am so glad you brought this up, because we can analyze operational leverage and ARR on a spreadsheet all day long, but money talks.
It really does. And the signal coming from the top right now is deafening. CEO Dan Wagner has purchased 9 million shares since January 1st, 2026. He executed these buys through his entity, DBLP CCOW.
Yeah, and 9 million shares is not just a token purchase. Sometimes you see an executive buy, 10,000 shares just to put out a press release and project confidence to the board.
Right, just for the optics.
Exactly. But 9 million is a massive structural absorption of the available public float. It is a cluster buy of epic proportions.
And if you're listening to this, actively building wealth and tracking these patterns, This is such a crucial mechanism to understand. There's an old Wall Street adage: an insider might sell their stock for a dozen different reasons.
Right. They might be buying a second home, paying for a child's tuition.
Diversifying their portfolio, covering a massive tax bill. But an insider only ever buys on the open market with their own cash for one single reason.
Because they firmly believe the stock is undervalued and the price is going to go up.
Exactly. When the CEO commits that level of personal capital, it completely aligns his financial interests with the common shareholder. He feels the pain of a dip, and he reaps the reward of a rally.
Yep. So we have improving operational leverage, sticky enterprise contracts, and really aggressive insider buying.
Right. So how is the broader market, and specifically the institutional money, pricing this in right now?
Well, the technical momentum on the chart is absolutely confirming the fundamental shift. Following the earnings release, we saw a massive breakout on March 30, 2026. The stock surged on incredibly high volume.
It wasn't just a quiet drift upward.
No, not at all. It was aggressive institutional accumulation.
Yeah, I was looking at the tape on April 2nd when the macro environment was really dragging down a lot of the major indices. Broad market futures were bleeding, but this stock was showing serious relative strength.
It was holding its own.
It was actually making lists of big names moving higher alongside heavyweights like Micron and Intel. That tells me buyers are stepping in to support the price, even when the broader market is shaky.
And analysts are seeing the exact same resilience. We have Maxim Group reaffirming a buy rating with a $15 price target. And H.C. Wainwright maintained their buy rating and actually raised their target to $12.
So there's a growing consensus that Wall Street had this mispriced as just a speculative development project.
Right, and now they're rapidly repricing it as a commercial powerhouse.
Now, there is a hidden layer of leverage in this play that we really need to unpack for you, and that is the warrants. Warrants can be a bit esoteric if you don't trade them often, but they offer an incredible speculative side play here.
Yeah, to clarify for anyone unfamiliar, warrants are essentially a contract issued by the company. They give you the right to buy the underlying stock at a specific strike price before a certain expiration date, and they trade entirely independently of the common stock.
Right. So right now, the warrants for Rezolve AI are trading around $2. Let's walk through the math of why that is so interesting. Let's say the warrants have a strike price around $11.50. If the main stock breaks out and hits that $18 to $20 range, the intrinsic value of the right to buy shares at $11.50 just skyrockets.
Yeah, at that point, the company will likely call those warrants to force conversion.
And the mechanics of that conversion process are what drive the explosive upside.
Exactly, because if the stock hits the upper end of those analyst targets, the math dictates that the price of those warrants could surge to roughly $13.50.
So you're looking at a potential move from $2 to $13 to $13.50. That is massive leverage without having to use margin or options.
Of course, the flip side is that if the stock stays flat or drops, the warrants can expire completely worthless.
Right. It's a highly speculative, coiled spring of a trade. And it depends entirely on the company executing on its upcoming catalysts.
Which brings us to the next few months, because their calendar is seriously packed. In March 2026, there was a very credible M&A rumor floating around regarding Reward Loyalty UK.
Oh, right. I saw that.
Yeah. If Rezolve AI is secretly using its newly found scale to consolidate market share and acquire complementary platforms, well, announcing a strategic acquisition could be an immediate upside trigger.
They also just made a major push at the Shop Talk 2026 conference. That event is essentially the Super Bowl for retail technology. It's the exact hunting ground you want them in for those high-value, sticky enterprise contracts we discussed earlier.
Definitely. Any major partnership announcements stemming from those meetings would massively validate the growth narrative.
Plus, we have the macro tailwinds cooperating for once.
Yeah, the broader tech sector is seeing a rotation back into high-growth names as rate hike fears ease up and geopolitical tensions in the Middle East show signs of stabilizing. When that macro anxiety drops, institutional capital flows back into high-growth AI stocks very quickly.
But all of those catalysts are really just the undercard. The main event, the absolute undisputed heavyweight catalyst, is their Q1 2026 earnings release.
Slated for late June or early July.
Exactly. And that report is going to be the moment of truth. Because as exciting as all this momentum is, we have to look for the trapdoors.
Yeah, we always have to look at the downside.
Let me play devil's advocate for a second. It's really easy to get swept up in the euphoria of a CEO buying 9 million shares and warrant math that could multiply your money. But projecting $360 million in revenue to Wall Street is a massive flex. It's a very dangerous game to play with expectations.
Oh, it is the definition of pricing your stock for perfection. When management guides for 360 million, the market prices that assumption in today.
Right. So if they come in at, say, $330 million, any rational person looking at the business would say, wow, you still grew by hundreds of percent year over year. That's an incredible company.
But to Wall Street algorithms and institutional analysts, that's a miss. It's a total failure to execute.
And that execution risk is the single biggest threat to the bullish thesis here.
Uh,
The entire hypergrowth narrative is delicately balanced on hitting those internal quarterly targets.
yeah. If the late June Q1 results show even a slight deceleration in enterprise adoption, that narrative shatters. The market will instantly reevaluate them.
They downgrade the multiple from a hypergrowth AI leader back to just a struggling software company that overpromised.
Exactly. You'd see a violent multiple compression and a really sharp sell-off.
Let's also revisit that profitability timeline we talked about earlier. They narrowed their losses, which is fantastic. The operational leverage is clearly improving. But the cold reality is they still burn through over $100 million in 2025.
And operating a global, production-ready AI platform is incredibly capital-intensive.
Right. The compute power required to run an agentic AI. Remember, the store manager that's actively rerouting supply chains and processing localized data for massive global retailers that requires astronomical server costs.
It really does. So if the cloud computing costs from their providers spike, or if the revenue growth slows down just a fraction, that cash burn will accelerate again.
Which leads to the ultimate nightmare scenario for any shareholder, which is dilution.
Yeah. If they burn through their remaining cash runway before crossing the threshold into actual profitability, they're going to have no choice but to execute a capital raise,
They would have to issue millions of new shares just to keep the servers running.
heavily diluting the value of the current equity pool. And honestly, that happens regardless of how many shares the CEO recently purchased.
So we essentially have a company standing on a nice edge between generational scale and a painful reality check. Let's synthesize all of this into a final thesis for you. Looking at the fundamental acceleration, the profound insider buying signal, and weighing it against the intense execution and dilution risks, Rezolve AI earns an 8 out of 10 bullish score.
Yeah, I align with that rating. It is a genuinely rare opportunity to capture a scaled software-as-a-service player right at its commercial inflection point. The target horizon here is an aggressive growth, 12-month hold.
But please keep in mind that 12-month hold hinges entirely on their ability to execute that $360 million guidance. If they hit the marks in Q1 and Q2, the upside momentum could be staggering.
But if they stumble, the floor falls out fast. It's a play that requires high conviction and really close monitoring of their upcoming earnings reports.
Absolutely. Now, before we go, I want to leave you with one final thought to mull over, something that builds on what we've discussed today. We are witnessing a critical pivot in the technology sector right now. The era of the generic one-size-fits-all AI, the kind that can write a catchy poem but can't manage a warehouse, is starting to lose its novelty.
Yeah, we are entering the era of hyper-specialized, industry-specific AI engines, moving away from parlor tricks and into actual hard-dollar commercial utility.
Exactly. If Rezolve AI proves that this vertical-specific model works, and works to the tune of hundreds of millions of dollars in sticky enterprise revenue, you really have to wonder what's next.
Right. Which industry is the next target for a specialized AI takeover?
Is it healthcare diagnostics, global logistics routing, maybe corporate finance? The companies that figure out how to build the store manager AI for those specific verticals are going to be the next wave of hyper-growth stories. Thank you for tuning into today's analysis. We'll see you next time.